Welcome back, everyone. In today's episode of Portfolio Analysis, we're going to investigate the ARK Innovation Fund, ticker symbol ARKK, and the historical performance of fund manager Cathy Wood. At the time of this recording, the ARK ETFs have lost about 40% of their value, and some people are starting to panic. Is this situation really as bad as it seems? Please remember, if you enjoyed this video or any of my research on YouTube or the website, please let me know by subscribing, liking the video, and writing a comment. Most retail investors first heard of Cathy Wood just a few years ago when her flagship ARK Innovation Fund had started producing enormous returns. If you watch mainstream financial TV, then you probably think Cathy Wood is some kind of investing genius that came out of nowhere. But in reality, Wood has been managing money for 30 years for various funds. I've personally got a small stake in ARKK, roughly about $7,000, so I watch the fund fairly closely. I noticed near the end of April of 2021 that ARK seemed to be a bit range-bound, trading in a consolidation pattern. Now, this is a perfect setup for a strategy that I use a lot called a short strangle, where you sell two naked options, one call at the top of the range and one put at the bottom of the range. As long as the price stays within this range for the next 30 to 45 days, then I get to keep all the premium that I collected from the option buyer, which was about $400. If the price breaches the call or put option, then I'm obligated to buy 100 shares for each contract that I sold at the strike price. Now, if I'm forced to buy, it's not a big deal because I'm already long the stock, and if I get assigned, I'm basically getting paid $400 to buy 100 more shares of ARKK, a fund that I already like.
Right there. The stock goes down. So what? Now you're long this stock.
Looking over the chart, though, there were definitely some warning signs here. For example, the ETF has lost 40% of its value in just 61 days. This is a massive decline for an ETF. For me, the most important signal that I watch is the 200-day moving average. At the time that I entered the trade, the price was about 9% above the 200-day moving average. If the price breaks below the 200, or more importantly, if it closes multiple days below the 200, then that's a massive red flag warning. Just generally speaking, when it comes to trading, you should never be long a stock or ETF that's trading below the 200-day SMA. You can see from the chart that ARK breached the 200-day moving average on May 10th, and it's been below it ever since. In response to this breach, I rolled down my naked call to collect some more premium and try to defend my short put. Anyways, all of this has got me thinking about the ARK funds themselves, and more specifically, Cathy Wood. Is she really the genius investing savant that CNBC makes her out to be? What's her historic performance actually like? Is she really worth all the accolades? If you take just a quick glance through Reddit, then it seems like the sky is falling.
¿Dónde van? ¿Por qué están tan asustados? ¡El cielo se está cayendo! ¡El cielo se está cayendo!
Every day, the subreddits are cluttered with posts from people who are planning to or have already panic sold out of the ARKK fund. Seeing these posts brings back vivid memories of the Fidelity Magellan fund. From 1977 through 1990, the Fidelity Magellan Fund returned an average annual return of 29%. The fund was run by legendary manager Peter Lynch, and back in the 1990s, a lot of people were making the argument that Peter Lynch might be the greatest investor of all time. For 13 consecutive years, Lynch returned an astounding 30% to his investors. Great funds come and go over the years. So this fund's fantastic returns aren't actually the most interesting part of that story. The truly amazing part of the Fidelity Magellan story is the fact that the majority of retail investors who invested in this fund actually lost money. Now you're probably thinking, how in the hell does an investor lose money buying into a fund that produces a 30% annualized return? It turns out that retail investors lose even when they invest in the best performing funds because they sell their shares anytime they read some negative news or there's any kind of drawdown. Then, whenever the correction is over, they turn around and buy back in the fund at higher prices. This creates a cycle where investors are constantly buying high and then selling low, which is an obvious losing strategy. So is Cathy Wood the next Peter Lynch? Is the ARK Innovation ETF the next Fidelity Magellan fund? Well, let's take a look at some performance data. Remember that Peter Lynch delivered 30% annualized returns to his investors over the 13 years he managed the Magellan fund. So let's take a look back at 13 years of Cathy Wood's history. We need to start pre-ARK Invest in order to get 13 years of performance. So we'll start in 2008. From 2008 through 2014, we'll be looking at the funds Cathy Wood was managing for AllianceBernstein. She managed several funds there, but I think the one that lines up best with ARK is the AllianceBernstein Global Growth Fund, ticker symbol ALTFX. As far as I can tell, the majority of the funds managed by Wood are mid-cap growth funds. You can't benchmark these funds against the S&P 500 since the S&P 500 is a large cap index. Comparing a mid-cap fund to a large cap fund, it's not a valid or a fair comparison. I picked a fairly run-of-the-mill mid-cap growth fund, the Janus Enterprise Mid-Cap Fund, to use as our benchmark. This Janus fund, it's not a top performer, but it's also not a poor performer either. And then to round things off, we're going to toss in a passive mid-cap growth index fund, ticker symbol VOT. Anytime we consider investing in an actively managed instrument, we should always compare its performance with a passive benchmark so that we know the hassle of the active management is worth the extra cost. These first 6 years are not great for Cathy. This fund only managed to deliver a paltry 1% to investors. The Janus Midcap Fund returned 7.5%, and the Vanguard Index returned 6%. The risk across all three of these instruments is fairly similar, but Cathy's fund did have the best single year, returning 56% in 2009. But the worst year and max drawdowns are about the same as the other funds. The Sharpe and Sortino ratios are fairly bad, implying that Woods' fund got very poor returns based on the risks that fund took. Of this 6-year period that we analyzed, Cathy Woods only managed to come out on top one of those 6 years. Let's fast forward to the next 6-year period, from 2015 through 2020. Cathy Wood had left AllianceBernstein to start ARK Invest. Her flagship fund, ARKK, has managed to return an astounding 35% annualized return over these 6.5 years. The ARK fund is a lot riskier than her earlier funds, but in this case, that risk has paid off substantially. Her Sharpe and Sortino ratios imply that, based on the risk taken by the fund, her performance is stellar over this period. If we evaluate each year on its own, there are some cracks that begin to appear. 2017, 2018, and 2020 are the 3 years where Wood outperforms the benchmark and the Janus Fund. 2018 is basically a scratch, but 2017 and 2020 are real blowout years. Now, you might remember in 2017 that Bitcoin exploded in value. It went from roughly $800 per coin to $20,000 per coin. And then in 2020, Bitcoin ran up from approximately $6,000 per coin all the way to $42,000 per coin. Now this begs the question, if we removed Bitcoin from the ARKK portfolio, what would the returns have looked like for 2017 and 2020? Now, I'm not going to do that because, in my opinion, Cathy deserves all the credit in the world for picking Bitcoin and putting it in this fund when nobody was willing to do that at this time. So I think we've looked at enough data at this point to answer the question. Is Cathy Wood running an elaborate pump and dump scheme? No, absolutely not. Of course not. Is she the next Peter Lynch? Well, maybe. She could be. Lynch produced 30% annual returns for 13 consecutive years. Cathy has produced 35% annual returns so far for the last 6.5 years. So we're just going to have to wait another 7 years or so before we can answer that question. Cathy's returns for the first 6 or 7 years following the Great Recession were not very good, but she seems to have hit upon some magic dust over the last 6 years. Now, some people are going to say that that dust was Tesla or Bitcoin, but magic is magic, no matter how it came to be. Can she keep this magic up? Well, the mathematical probabilities are definitely working against her, but only time will tell if she ends up bucking the odds and securing her spot at the top next to other great fund managers and investors. As for my ARK holdings, I don't have any plans to sell. Now, I won't be adding any more until the ETF breaks above the 200-day moving average and proves to me that it can hold that price, or, my options get exercised and I'm forced to buy more.
Right there. The stock goes down. So what? Now you're long this stock. Our cameraman's doing it with me. Yeah, Doyle's about.
I'm sexy and I know it.
Keep it going.
I'm sexy and I know it.